And now I'm sitting with more money than, I thought I would have for a long time in my bank account as somebody in their mid-20s. And my question is, what do I do with it? Can't go buy more houses because the housing market's crazy. I was looking for where can we do something where we're not waiting on good luck, where we can kind of take a lot of that into our own hands and start to drive value with our work. And storage was a perfect fit for that. And we did the first facility and kind of never looked back. No matter what journey you're going through, no matter if you're gonna I have the money, I'm gonna do this myself, I'm gonna do this on the side with my job, I'm gonna syndicate, I'm gonna do this. There is no shortcut. Your first few years are going to be a grind. You need to really look at your situation, your family situation, your finances, and like I said, this decision about how am I gonna go about it, how am I gonna capitalize my efforts and build this business. Be really intentional about it, and whatever you think, however long your timeline is, go ahead and double it and prepare for that. It's a grind no matter what route you go on.
Welcome everybody to Self-Storage Income, and today I have a guest with us, Faraz Hemani, and I'm really excited about this. He has worked for Google, and he talks a lot about technology in his storage facilities. But dude, how you doing? I appreciate you coming on.
Oh, thanks for having me, man. I mean, you're the man. I love this show. It's awesome to be here, so I appreciate it.
I'm really excited to talk to you. You have an interesting background, one that we don't see very much in storage. And it's one that is actually, you don't see a lot in real estate. So why don't you give us an idea of your background here before we start talking storage?
Yeah, for sure. So my background is I worked in technology for about 7 years. And I'll caveat that I wasn't like the brainiac super programmer coder. I was a guy selling the stuff that the super coders made. So I was in tech sales for about 7 years, living in Austin, Texas. I worked at awesome companies and had the privilege of working at places like Oracle. I worked for 4 years at Google, which is just a badass company to be at. And along the way on the side, I was lucky enough to have some mentorship from managers that said, hey, you're making some bonuses in your sales job. You're doing well from yourself. Put that money to work. Buy a rental property, buy a house. And that was my first exposure to real estate. So doing that on the side for about 4 or 5 years before jumping into it head on, that was kind of how I found that intersection between technology and real estate. And fast forward, just really loved the real estate side of things. It was something I felt like I could wrap my head around. It made sense how money comes in, how money grows, how you use leverage. And that eventually got me to a point where I was in position to do this full time. Left my job at Google, which still some days I wake up like, God, why did I do that? That was an amazing job, but no regrets. I haven't looked back since, and it's been a fun ride.
Awesome. And tell us about today. What are you doing today now?
So today, I run a company, Pebble Ridge Capital. We buy commercial properties all over the country. We syndicate them, meaning we're partnering with investors on them, and we've primarily focused on self-storage. We operate them all in-house under our brand name, Iron Storage. And today we're up to 25 stores. We're in 6 different states and looking to grow.
Amazing. I love this trajectory. It's obviously, for those that are listeners and everything, know how much I feel the same. I was in insurance sales, and I left that to do this as well. And I tell people, when we made the choice to go do it, one of our employees literally said, wait, you're going to leave this white collar industry, this insurance, you're dealing with self-funded people and, or self-funded dollars for companies and this high level stuff to become a slumlord. And that was the view when we got started. It was storage is a junkyard. And, that was back before 2008. And it puzzled people that we would even consider doing that. And it's hard to explain sometimes. So I can imagine that you get looks when you say, oh, I was at Google and I left to do self-storage. I'm sure a lot of people kind of go, huh? Like, that's an interesting route.
Yeah, 100%. I remember about a month or two after I left, we had just bought a storage facility. So now I'm doing this full time. And it was a small, honestly, dumpy little storage facility. It needed a lot of work. It was about a 5-hour drive from where I lived. So I took my little brother with me, said, hey, come help me out. We're going to be there for a couple of days, cleaning all this stuff up, with our own 2 hands. So I'm driving with him. In my mind, I'm like, he's going to love it. I'm going to show him entrepreneurship, and I'm going to show him what it's like to run a business. And when we get there and we're cleaning trash and all that stuff, he's like, dude, are you an idiot? Like, you were just working at this cushy job at Google. Now you're over here picking up trash and cleaning spray paint off the walls. And so it's a thing that sometimes I think some folks do have a hard time wrapping their head around. But at the same time, especially in today's day and age, folks love entrepreneurship. Folks love that American dream. You're going out and doing your own thing. And, I think I've been lucky enough to get ton of support and encouragement for making a decision like that. And I'm sure you have as well.
Yeah, it's funny because I have similar story. I was running our brokerage firm in our state where we live, and it was working for the second largest one in the country, and I was running our branch or a division here in the state. And I got a call that our storage facilities were flooding because of ice in the local area. So I ran out of there, went to the storage facility, and I shoveled the ice out of the drains for hours till my hands were bleeding that afternoon and that evening. And it's one of those moments, like you said, I'm freezing and my hands are like bleeding. Their blisters are coming off as I've been doing this, and thinking to yourself that I just walked out of an office where I was sitting there reading stuff. And the funniest thing about it is, though, I would have rather been doing that. And that can be hard to explain, but this is something I'm creating, and this is mine. And it was about where we were going, not where we were at. But any reasonable person would have been like, dude, you've lost your mind, right? Like you got a great career. You got this, long runway. Now, tell me about storage, though. You talked about you're doing other real estate assets. You now know you like the real estate game. You like the passive income, right? You got the bug. Why storage?
That's a great question. So started off just purchasing single family homes, doing them as rentals. Got up to doing about 6 or 7 of those. I was living in Austin, Texas at the time. And I didn't have my own money to do all those deals. I was in my early 20s. So I bought one on my own, 5% down. I knew I wanted to do more. So I went back home to Houston, where my family's from, where I'm from, and I just started telling everyone about what I was doing, hoping that somebody would be like, oh, I'd love to buy some property in Austin. And eventually found one person, said, okay, I'll put up the money. You find the properties, you do the work, you lease it out, you manage it, and you take a cut off the top. And so I said, perfect. And that's how I was getting up to about 7 or 8, I think 8 properties in Austin at that time. Unbeknownst to me, this is kind of what syndication is, right? Raising money from investors and, getting a little bit of a cut for doing well. And I had never heard the word syndication. I still would not learn that word until about 2 years later, but I started doing that. Housing market went absolutely nuts during COVID, especially in Austin, Texas. So, me and that one partner decided to sell everything. And now I'm sitting with more money than, I thought I would have for a long time in my bank account as somebody in their mid-20s. And my question is, what do I do with it? Can't go buy more houses because the housing market's crazy. So I said that was probably a good time to look at commercial real estate. So we played with different things. When I say we, it's me and the same partner. Bought a shopping center out in Houston where I live, and I enjoyed running that. But we felt like, how much can we really do and add value? I hand this to a leasing broker. They go lease it. I personally, however intelligent I think I am, I feel like I can't really do much to help this investment. I'm just kind of sitting here. And actually, it was listening to folks like yourself. You were a big part of it. And understanding why storage is so different from a lot of the other asset classes, because the operator is super involved. There's so many levers you have to be there pushing all the time. And if you do a good job of that, you get rewarded. If you're really good at marketing and customer acquisition and customer service and pricing and all of those different components that are involved in a storage facility or storage operation, you are going to get paid, or you're going to see the value of that work reflected back to you. And so it just came back to this question, especially after winning in the housing market, quote unquote, where the win was nothing to do with us as operators. It was pure luck. I was looking for, where can we do something where we're not waiting on good luck, where we can kind of take a lot of that into our own hands and start to drive value with our work. And storage was a perfect fit for that. And we did the first facility and kind of never looked back.
Yeah, I was having a conversation with someone this morning. We were on the phone and we were talking. He's like, why storage? And why did you like it? What do you do? I go, well, the thing about real estate, when we started to get into it, I absolutely hated this idea that everybody would say, real estate's a sure thing. You always make money and it always goes up. And when I'd say, why? No one could tell me. And, back then, that was my driving question, because we're talking prior to 2008, single family homes. And I'm like, why though? And there was no answer. It was that this magical Mr. Market will just make everything worth more. And I'm like, I get that. I understand. Basic supply and demand. We don't have more land. I get that. Over time, it will just be worth more. I get the concept, but the actual application of building a business around that, to me, seemed terrifying, because I'm like, compounding, I need to know what the return I'm going to get. And then I need to know how to do more of it. And I need to be able to condense the time frame in which I'm doing it. But if it's just Mr. Market, I can't plan on any of that, right? I don't know the time frame. I don't know the returns. I don't know what any of those things will look at. So for me, as a cash-based business guy, which that was what I ran and I looked at capital. How do I return capital into a system and what return am I going to get? That terrified me. And frankly, I thought it was crazy. Where storage, that's why I love storage. Because I'm like, this isn't real estate, it's a business. And meaning that I could put capital in, I could actually measure the upside return, I could get it out, return it, and I could compound it out in a way that you just couldn't do with other assets. Now, you take a different kind of approach. We're going to talk about this. Oh, first of all, walk me through you mentioned you got 8 assets in Houston, I think it was. Walk me through the time frame. So when did you buy your first deal? Walk me through that, and then walk me through scaling.
Yeah, 100%. We bought that first facility. It's not too long ago, January 2022. And that was right outside of Houston, Texas, where I live. And I wanted to be close by so I could drive over there. We bought that one. Didn't buy anything else for 6 months because, in my honest answer, I was so busy running that one. And I took it upon myself to try to do everything at that store and at that facility so I could really learn the business properly, meaning I didn't have a call center. I was the one when customers called, I was answering the phone. I was taking payments. I was driving there to sweep out units and clean hallways and do repairs. And I did that for about 3 or 4 months, like intentionally not outsourcing anything. So I could really understand where are the things that can go wrong, where are the hiccups. Because one thing I'd heard about storage or the folks that were kind of already doing it at scale is you get a playbook for something like this. It's very repeatable. You learn how to dial in operations and marketing and this. You can take that knowledge and go apply it to the next deal and the next deal. So I said, okay, let me get that basis of knowledge. And it wasn't until maybe 6 months later that we bought the second deal. And after that, the floodgates kind of opened up. We were starting to, this is when interest rates were still super low. We were buying a storage facility almost every 6 weeks at that point. It slowed down considerably since then. But then over the course of the next about 2 years or so, 1.5 years, we scaled up to a point where we're now at 25 locations, across the whole southern United States.
When you say southern United States, are you talking Texas or is it more than that?
Yeah, more than Texas. So we are Texas to North Carolina and almost everything in between.
Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it? Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you.
You obviously, I'm going to take a guess here, but I think your strategy probably involved a lot of maybe technology and Google, things like that. Walk us through what your thesis and strategy is. So in order to do that, so steps here. So I break it down because I like to ask lots of questions, then you'll get lost in all of them. So let's first go your buy box. So what is your buy box? What is the facility you're looking for? And then what is your strategy with that facility? Because obviously the strategy will dictate what you're buying. So what are you looking for? And then why? What is the strategy behind that you're deploying for that facility?
That is a real good question. And so here's how we think about it here. Sometimes we say internally at our company, we feel like self-storage is really almost two kinds of asset classes in one. There's one type of self-storage facility. That's the one you see when you're driving on the highway and you're at, the overpass and there's a 5-story building that says public storage and it looks awesome and you can see in through the windows. And that's one type of storage facility. We'll call those the Class A storage facilities. Really nice, typically not mom and pop operated. It's usually a big national company, publicly traded company. Other subset of storage, which is where we play a lot, is what we'd call sub-institutional storage. And that's going to be more of, these are drive-up units. They look like a bunch of garage doors all lined up outside, sometimes often like gravel or concrete or, nothing super fancy. I'll put it that way. And it's typically those that are owned by your mom and pop owner, the person that maybe is local, owns 1 or 2 stores, something like that. And we play a lot more into that area. And there's a bunch of reasons why. That's where it goes back to the point we just talked about, right? Where can I go put capital in and feel like I can get a predictable return because of things that are in my hands and my control? We feel like that, we at least find that a lot more in kind of that sub-institutional space. Because, like I said, there's inefficiencies for us to capitalize on. I'm not going to sit here and kid myself and thinking I can go buy that multi-story that Public Storage or one of those guys is running it. I'm going to come run it better than those guys. Maybe marginally, but that's not what I'm building a business around here. That's not something I can do over and over again. But, and like you talked about with the technology side and all of that, there's a lot of things I feel like our company could go bring to that sub-institutional space that the owners are not currently doing. And a lot of those value drivers that we can put into place there. And then really have firm foundation in our thesis that we can buy a storage facility and make it more valuable and make it more profitable. And we find the best ability to do that in that sub-institutional space. So that buy box is really the mom and pop owned between 20 to 50,000 square feet, typically, storage facility where our overall goal is we think we can come in and make this a more profitable operation.
When you're looking at that back, so when you're looking at OH, obviously my listeners, they all know and everything. That is, kind of our strategy and what we're looking for. When you look at the mom and pop space across the United States, as we're going to call it, sub-institutionalized, there's a few reasons that make things sub-institutionalized. We obviously have the asset itself, but then we also have the market. So you may have an institutional grade asset in a market that institutions won't buy in, and you may have assets in institutional grade markets that they won't buy. So my question is, when you look at that, which is generally for this discussion's purpose, we're going to say a facility that's under 50,000 square feet, institutions don't buy, and they don't buy one-offs. Especially. Now, we do have extra space that made a huge portfolio purchase, but I'd argue that was to buy the infrastructure, the technology stack, everything else like that, more than it even was the assets. Outside that, though, especially one-offs, they're not going and buying under 50,000 square feet. Now, markets, too. That's generally true that when you start to look at sub-markets below second-tier markets, the institutions don't really play in. And so when you're looking at that market and that size of facility, what is that market buy box and what is your size buy box?
Yeah, this is a point that we debate a lot internally. It's really funny that you brought it up that, hey, because we're typically in smaller markets, I'll be honest with you. We're in markets like Tupelo, Mississippi, or, outside of Tulsa, Oklahoma, and I'm not saying we have facilities in Tulsa, but we also have facilities an hour outside of Tulsa, right? So small markets oftentimes. And I would definitely...
Me too. I'm in Tulsa.
Yeah, actually, you're right next door to us, actually, believe it or not. But
that's awesome.
Yeah, no, it's super funny. I remember looking that up when we were looking at comps, and I was looking at the owner, and it's I forget what your actual real name is besides AJ. I'm like, this name sounds familiar. Oh, that's AJ Osborne. Yeah, there you go.
Yeah, Austin.
Yeah, that's what it was.
Comes up legally as Austin.
Yeah, we're right down the street from you guys out in Tulsa, But you're right. I mean, look, when you look at one of our individual assets, if you look at our store in Tulsa, for example, which is only 17,000 square feet, there's not going to be a line of institutional buyers clamoring to buy that asset because it's too small on its own. There's not a ton of REIT presence in Tulsa, as you know. There's maybe one or two bigger players, quote unquote, regional players out there. And that's true of a lot of our markets like Tupelo, Mississippi, et cetera. But here's what we're seeing, and here's one of the bets we're making. You mentioned, right? Storage Express got bought by Extra Space, and that was probably a one-off kind of thing. Extra Space wants that infrastructure. Outside of that, the REITs, those top buyers, really aren't buying the stuff I'm buying. But how I said storage is almost 2 or 3 different asset classes in one, like there's subcategories. When we throw around that word institution, we almost think of that. There's subcategories to that. There's obviously the REITs. That's as big as it gets. Then you have really, really, really large funds under that. Like our private companies, the Merritt Hills, and all of those. But between them and me, there's whole other subcategories of fairly large buyers out there, private equity buyers that are raising sometimes $100 million funds. And the problem that they're seeing, that every buyer in storage is seeing, is there's so much more competing capital with less assets to buy and less assets to compete on. And what we're seeing is the funds, maybe the REITs aren't doing it and maybe they don't have a need to, but the funds are going further and further out into their buy box. We are seeing more and more money getting thrown into smaller markets where they weren't before. All right. Now, they won't want to buy a 17,000 square foot asset, right? Because that doesn't push the needle for a $100 million fund. But what if, an hour outside of Tulsa, we do the dirty work of buying 9 or 10 facilities all within a 20, 30-minute drive of each other. Now we have 200,000 square feet that you can put a regional manager in place, run as a hub and spoke. It's a stable asset now after we've run it. That maybe several years ago wasn't enticing for the bigger money funds out there, but today it is. And today,
Private equity, especially.
private equity. So, when we say institution, yes, public storage may not be the one that wants to come buy our assets, but there are large private equity funds that will come and pay us those quote unquote institutional multiples we're looking for. And that's becoming more and more prevalent. And that's one of the bets we're making in the business.
And that didn't exist. That literally didn't exist prior to 2017, 18. So they were starting, but it was so rare. And you're right, there's multiple levels. Like I view us as we're 3 levels down. Let's say you have the REITs, the $1 billion ones. Then you have the funds that are more institutional grade. Like you're talking, they're deploying $100 million at a time, right? So these are private equity funds that are really big, right? And then you have more my grade, where I'm like 50 to 100 million a year I'd like to deploy. We have about $500 million in assets, right? And so we're that 3rd ring down. Then the 4th ring down, you have a whole nother level, and that level too. So that level down below has gotten massive. Like this $100 million in assets range. So somebody that wants to deploy 20, 30 million, and they want to make $100 million portfolio, right? So we have those people that want to buy 8 of our assets, right? Or not. And I am shocked at the degree in which that's grown. And they will pay institutional level because these are institutional people. These are your finance guys. These are, those, all they're looking at the cost. They have a capital spread. And so the institutional level of thinking has gone down market. And the people that are breaking off to come into the market from institutional backing. So that's really gone down through the assets and the markets and how underwriting has changed. Now, super small markets, right? It's still so tied because you have the financing structure, first of all. So if anybody's using debt, markets are subject to banks, and that is actually the main driver. And I tell this to a lot of people. I go, investors may want it, but the actual driving reason on the pay for anything in those markets, if it's not cash, then it has to be in line with banking standards. So if you say this is worth a 5 cap, but a bank says, no, it's worth an 8 cap, it doesn't matter if that person wants to buy it or not. They're paying an 8 cap now, unless it's in cash. So that is the big thing right now that I see that's really screwed up a lot of those lower markets, is that you have the investors and they're literally like, I can't deploy it. Financial institutions aren't giving us the valuations or the metrics that we're at. And then you go into the upper markets and they're still trading they're crazy because it's not tied as much to it. But that continual push down, right, we keep seeing, and it's driven on the private equity side, which acts institutionalized. That is new in the last 3-4 years.
Yeah, no, 100%. I think that's the best way to say it. I never really thought about it the way you're saying it, but you're right. It doesn't even have to be that the buyer is an institutional sized buyer. They just have to be an institutional minded buyer, right? So you have a lot of ex Wall Street guys or guys that left and broke off from bigger shops when times were good and they had a lot
Publix, Extra. Those guys have all been leaving and starting up.
And you make a really good point about the financeability of what's happening in lower markets and what are banks' appetites to participate in all of that stuff, right? Because, it's a question sometimes folks ask me or, like folks that are starting out, they're looking at deals, they're underwriting, and then they get to a point where like, Faraz, I see the guys that buy those bigger deals out there, the ones, the multi-stories and primary markets, and I see the prices they're paying, and I plug that into my model, and it's negative. Like I can't get the numbers to turn positive and all that. So we have to understand, right? Capital is totally different in that sub-market versus or subclass of storage versus this subclass. And you're right, in this when times are good, right, like they were 2020, 2021, maybe the spread between what the capital looks like in the small markets versus the big markets, maybe that's a small spread because capital just has to get out the door, right? There was so much of it. So maybe the cap rates were similar and the type of financing was similar. But now when maybe capital gets a little more picky, for lack of a better word, right? Or banks and like are really taking a hard look at their books, like we should be really thoughtful about where we're putting out capital. Now that spread starts to widen. Now you're seeing debt, constants on the smaller markets look really different. And as a result, cap rates in the smaller markets look different. And admittedly, that's one of the sometimes downsides to being in those smaller markets. And the way we think that we should be combating or hedging that risk, okay, well, if we're going to go into smaller markets where there's risks, like today, the cap rates expand way quicker, we need to be able to position ourselves to be long-term holders then, or be able to hold long-term because, things go in cycles, right? 2 years ago, the facility in Nowhere, Oklahoma was selling at the same price as the facility in Oklahoma City on a cap rate basis. Today it's spread. There will be a point where they start to slowly converge a little again, and there's going to be a point where they spread again. And this is what cycles are in economics and real estate. And the key for us is we don't want to be prisoners of the moment. if a current moment is not super advantageous for a refinance or sale or purchase, we need to be able to position to be weather that out and come out on the other side when markets normalize or markets come to a more favorable position, and we want to capitalize on that.
Yeah, 100%. Our philosophy, is very much around the market is more of an enemy than they are an ally, because the market has no care to who you are or what you are at all. So when they lift it up, you're just a byproduct of valuations rising. It's not an ally. It's just a byproduct. Now, the market, though, will absolutely slaughter you. And so we can't be, our business model can't be contingent on those short-term things. I went through 2008. We owned, we operated. I saw what the market did to people. And I saw when people lost their assets, even though their assets were making more money than they were the year before. That was, to me, wild, which I didn't understand, because I didn't understand how people were financing. I'm like, that doesn't make any sense, because how'd you lose it? It's making more money. Because, we would never finance on a short term. We would never do those types of things. And so we make sure we say we'll win in the long term. And when Mr. Market benefits us, we want to be able to take advantage of it. But we don't want to get into what I call value traps. And that's this idea that the value that the market is setting on it actually becomes a trap that kills you. And that's really an important thing to think about, because like you said, the markets, the cap rates, they go up and down, the debt, it goes back and forth. And that's where people get in trouble. And that's something that is also, though, avoidable.
When you guys are looking at property management software for your storage facilities, there's a ton of options out there, but no other option compares to Tenant Inc. Tenant Inc. is going to be your one-stop shop solution that has an amazing amount of tools that you can deploy at your fingertips to maximize the value of your facility, to operate it more efficiently, more effectively. They have an open API where you can back in almost anything you want. You own your data, and it's just an incredible solution. I can't say enough good things about these guys. Link is in the show notes. Be sure to check out Tenant Inc.
Let's talk a little bit about the syndication side. You mentioned that you syndicate, you raise capital, right? That you're doing this. A lot of people are trying to align how to execute with their overall goals, right? What is your goal, and why have you chosen the path to go down to accomplish it that you have?
I talk to a lot of folks who don't syndicate, who buy their own deals with their own money or with one partner or something like that. And they'll always tell me, oh, I got to do what you're doing. It's awesome. You know what I mean? And I'll tell them, well, sometimes I'm envious of the way you do it. It's all yours. You own the upsides. The grass is always greener. And I use that point to illustrate that there's no right or wrong way to do this. It's like what you said. What's your goal? So for me, I wanted to do this I wanted to spend all of my time and energy on this, because I felt if I commit my mind to this, when I say this, I'm talking about real estate and storage, I can really build something meaningful over the long term. The bottleneck that I would encounter had I tried to go it alone without syndication is I would buy one, maybe two facilities, and then I'd be sitting for a while, and the compounding would take a while to, I'd have to wait until I have an exit event or a refinance event. So for me, the way that I thought I could scale and get to my goals the fastest, the goal being, how can I quickly compound wealth? How can I had the secondary goal that I kind of discovered once I got started in the industry. How can I start to build a platform in the storage industry, right? Where I have so many different locations, and they all benefit from the shared infrastructure of management and data and insight and, a whole team supporting it. And I saw that those goals were really only accomplished when you're bringing in outside money, when you're doing it kind of through syndication. And so that was the big reason that I went ahead and did it that way. I had goals where I wanted to get to a certain place. I wanted to get there quicker than it would take me if I had gone, doing it without outside capital. And then within quote unquote syndication, there's multiple ways that people are doing it. You can go raise money from one large private equity or family office. We've been raising from bunch of individuals. We have like over 100 investors we've raised from. And I've liked that approach a lot. It gives us kind of diversification on every deal. It exposes us to different points of views and understanding the market for investors. What are folks looking at? And I like it. Basically, long story short, it's allowed us to make our business kind of like a rocket ship. And the fuel for that is kind of the way we're capitalizing through syndication. And it's been great doing it that way.
I kind of have an interesting view on this, because I started out not started out, for 20 years, 15 of them, we did not use investors. So it's only been in the last 5 that I took on investors. And a lot of people are like, oh, which one was right? Which one should I do? And I say, no, first of all, it depends on what abilities you have. Most people don't have the ability to do it on their own, right? And you have to remember that I was buying in a time where I could get 12 caps. So I had another thing going on, and that was wind in my sails. Now, that was though caused because I was executing and risking in extraordinarily difficult, harsh times. So we got those things because of the fact that we did what nobody else would do. But still, right, it allowed me to deploy capital at a range that if I started today, I could not literally do. I could not get the assets I got. I couldn't, I mean, not even close. Some of the assets I bought for $2.5 million are worth 15 today. Now, that's how real estate works though, and that's how time. So it doesn't matter, that will always be a problem. So anybody that says, oh, well, I didn't have that, that's exactly what everyone's going to say about you in 10 years. That's literally how this works. So the fact of the matter was I had to work full time, and my partner, who's my dad, we worked full time I did 5 years. I never took a dime out of my real estate business. I worked another job to pay for everything, and all the money went back into it. I worked another 5 years after that, and I took barely any money out, a little. And I mean, this is a 10-year streak of me doing this and not making money. That is unreasonable, probably for most. I had a sales job, which allowed me flexibility and things, but I worked two full-time jobs, and my family, they bore the brunt of it. And there's no ifs, ands, or buts about it, right? So for me, I'm like, I'm glad I did what I did, and I'm happy, but I probably should have stopped sooner. 10 years was too much, right? But at the end of the day, I look at it and I go, I had to do those things because I didn't raise capital. So my money, I couldn't take anything out. We had to refinance. It was way slower. I mean, legitimately, if we would have taken capital just 5 years earlier, we'd be at like $2 billion, just taking the exact same ratio of capital we were deploying. And that's it. Like, not even saying we were scaling it up. Now, does that mean it was wrong? Does that mean I regret it? No. But it's what the opportunities were at my feet. It's what I knew and I understood. And I think that's the key. When people say what's right or wrong, it's like, well, what opportunities do you have and how can you execute on them? And it's not the same for everybody at all. So should you go to institutional? Should you not? Should you quit your job and raise money? Should you not? It's like, that is what matters is you take all of these things that you did, I did, others did, and you put it together how it works best for you. That's the key. And I think like what you did is what I would do if I started over again, right? And so that would be a thing that I would do. I have more experience. I have understanding. When I got started, there weren't podcasts. There was no books. There was no real estate education. There was no social media. So the only thing I knew about investors is they take the company. I didn't know anything else. So for me, obviously it was different. Everybody listening to this podcast, the education that you have from this podcast right here, listening to you, listening to me talk, this is a million times more than I had in over years, right? So I think that people, we can understand now we can do it different ways. And that's one of the things I love about how you're structuring and why you chose to do what you did and how you're doing it. And I think tearing down a lot of those beliefs and limiting beliefs, like I had even, that I can't take investor capital because I'll lose my companies, and that may be wrong or right, because people have these staunch beliefs about it, right? It's like, nope, that's wrong. You shouldn't do that because of this. Or, no, this is right. You should do it because of this, always. I don't see it like that. And I don't see it like that at all. So I think that, that flexibility and understanding how you took your path and grew is really good for people to hear because it changes their perspective.
1,000%. I mean, you said it best. There's no one right path. You have to look at your situation, your goals, where are you coming from and where you're trying to go. And you're going to find a mix mash of things that works for you. Are you taking employment on the side or not? Are you syndicating or not? This and that. But I'll put it this way as well. Like I said, there is really no right answer. I mean, there are folks who are not syndicating that I'm personally super envious of. I'm like, I wish I did it the way you did it. And there's folks that are syndicating that I'm like, oh my God, you should probably stop. You're going to put your family in a bad situation. But I will say this. You told the folks just now that, hey, because I went at it alone without outside capital, you kind of had a slog, like a grind for 10 years, right? Putting your family in kind of that financial, situation, or, just not taking a ton of cash out of the business.
So I was working 2 jobs.
It's incredibly tough. I'll say this, because this also comes with a lot of, with syndication or entrepreneurship in general, sometimes there's almost this belief like, oh, you're your own boss now, or you're good, you're making money. I'm the lowest paid person in the business, right? Myself and my partner, we don't take money out of the business. All of our employees right now, majority of them make more money than us. And that's by design. When I left my job, I looked at the money I had in my account. I had a good amount in there from selling a lot of those houses that had appreciated in value. I said, okay, of this money, half of it, I'm going to invest in building the business. That's going to help me fund my payroll and get things off the ground. And the other half, I'm going to live off of for a couple of years. And I thought to myself, this is 2 years worth of living expenses. I'm going to be just fine. That's a 2-year runway.
Really fast.
2 years went by really quickly. You know what I mean? and it is, no matter what journey you're going through, no matter if you're going to I have the money, I'm going to do this myself. I'm going to do this on the side with my job. I'm going to syndicate. I'm going to do this. There is no shortcut. Your first few years are going to be a grind. You need to really look at your situation, your family situation, your finances. And like I said, this decision about how am I going to go about it? How am I going to capitalize my efforts and build this business? Be really intentional about it, and whatever you think, however long your timeline is, go ahead and double it and prepare for that. It's a grind no matter what route you go on.
Oh, 100. I could not agree with all of those things and more. It's just it's hard to express for people that haven't been through it to understand it. And it's one of the things that if you know it's what you want to do, like entrepreneurship, if you believe in it, it's what you want to do, and you're in it. That's why, though, it takes that. That's why it takes that belief and that commitment, because of the fact that your assumptions are just assumptions. And when they go to play, right, and you actually go to roll out those assumptions or your business plan, right, that it's all over, right? Whatever, Mike Tyson said, everybody's got a plan until they get punched in the face. That's entrepreneurship to the T. You got a plan, and then the market's like, nobody cares about your plan, dude. And so then you have to change, you have to adjust, you have to work within it. I mean, my business plan from when I started, when I originally pitched this idea to my dad and my other partner, Sam, when I was like, look, this is what we're going to do. It's funny looking back at it and even looking at it, because we ended up going so totally different in a different direction, right? But the fact of the matter was we got started and then we could change and adjust. Why? Because we saw opportunities. We let the market tell us, and then we adjusted for it. But you have to be willing to do that. Stick with it. Go through it. It doesn't work because the market's going to tell you this is wrong, this is right. You don't tell the market. You don't tell the market, no, this is my plan. And I see a lot of entrepreneurs that aren't willing to do that. They say, no, this is my company. It's not your company. It's your customer's company. Because if they don't want it, you don't have anything. You got to think about them, and you got to listen to the marketplace and listen to what they want you to build. And entrepreneurs that say it has to be this way, I have to do it this way, I have this much time and I want to make this much money. I'm like, you need to get a job, because it's just that's not how it works. And you got to be okay with that, right? And I'm okay with it. I'm okay working and earning, just like you said, living off this, and I'll adjust and I'll fix things and we'll move. I actually think that's the fun of it.
Yeah, 100%. That's what makes this fun. If we had a plan, and every day for the next 10 years, I just set out to do that exact plan. I mean, that's nice in theory. I'll probably make a lot of money, but where's the fun in that? Like you said, you were out there shoveling ice out of water drains and all of that. That wasn't in your plan on day one, I promise you, right? It was not. But look at the stories you're sharing with me on this podcast, right? It's all of the stuff that goes off plan, and then your Herculean effort to try to bring it back to where it needs to go. That's the stuff you remember. That's the stuff you get paid for. That's the stuff your kids hear about. And that's the stuff that provides fulfillment. And it's liberating to know this as an entrepreneur, because you talked a lot about self-limiting beliefs, right? I had a lot of those when I was leaving my job. Am I screwing up? This is a good situation. Am I cut out for this? Sure. I'm smart, but am I an entrepreneur? Can I run a business? But all these things, can I hack it? What's really liberating is once you're in entrepreneurship and once you're running your business, you discover this. It's really not about how smart you are, how talented you are. You talked about it. It's getting punched in the face over and over and over again. And the person who wins in entrepreneurship, all it takes to win is who can take the most punches and not give up, right? Who can keep getting punched. So that's all you need. If you want to be successful in business, just know this. You don't have to be the smartest guy with the richest family and all the connections going in and all those things. Are you willing to stand there and take a punch over and over again for 3 years? If you are, congratulations, jump in. I promise you, you're going to do all right. As long as, like you said, you're willing to adapt, you're willing to, take the opportunities in front of you and do that for a long period of time and be patient, you're going to win and just fine. And I find that to be super liberating and like super empowering for folks looking at this type of business.
I do too. It's interesting because I think people look at me now and they're like, oh, well, all this information, right? And they're like, you just understand this so well and you're smart and stuff. I'm not like that. I don't know any of this stuff, everything. And I'm kind of like, what did you think it was like when I started? Like that, I didn't know this. This is like, that's not how it worked. And I didn't even tell people that we were in storage for like a decade because it was weird. People didn't even like it. They were like, why? So literally we did this thing and this thing on the side and we were learning. It started out, it wasn't even that great, to be honest. I was wondering after 5 years, I was really frustrated because I'm like, I don't know if this plan's going to work out like how I wanted it to. I wanted it to replace my income. I wanted to do this and I'm still kind of working at this for free. And we had these issues. Eventually I think all entrepreneurs, they learn to love the punches. And the reason being is that's the market talking to us. And then instead of even fighting against it, they punch and you roll with it. You go with it. And then all of a sudden you get faster and faster and you can take more and more and more. And the punches actually end up making you not only stronger, but who you are. And that's, I think, what I learned. And I learned to close those feedback loops faster and to take them even more. And it's funny because that's the very thing that actually ends people. They get hit and they stop. And you're like, that was your first sign you're doing what's right and you're on your way. The first time the market told you, congratulations, and you quit over it.
Yeah, 100%. How are you supposed to push your business to the limit without crossing the limit a few times and getting pushed back? You know what I mean? If there's no other way to grow and push those boundaries until you get there. And that's what's happening in storage right now to some level. You said there was explosion of folks and outside capital and like kind of that fourth tier of like smaller syndicators and all of that jumping in the market 2020, 2021. I consider myself to be one of those. I was in that wave. At that time, you're buying properties. The market is at your back. I mean, it's lifting everything. NOI is going up, rents are going up, occupancy is going up. You don't have to do anything. You were buying properties, you ripped rents 30%, you put a website up and you sat back and that worked. And now it's not working, right? You can't just go in and buy something and rip the rents and hope nothing happens. And the market, you're not just filling up without trying. You have to be really intentional about customer acquisition. So whatever was working a couple of years ago, it's not working today. And if you're not willing to adapt, that punch that you're getting right now really, really stings. And so, and I know you will agree with this, you're seeing now what the good operators are doing and who the good operators are and what makes them good is they're learning to adapt and roll to that punch. Okay, demand is down, rents are down, occupancy is down, marketing expenses are up, insurance is up. That's a bunch of punches to take at once right after a really, really good period. How are we going to roll to those punches? How are we going to adapt, right? And how are we going to make it so that, we take those punches and we get calluses from them in the sense that we're prepared to deal with this the next time it happens. Our business is stronger for this, not weaker for taking that punch. I myself as an entrepreneur, I'm stronger for going through this, not weaker. And so, and if you can just have that mentality and do that over 10 years, even for example, in storage, you're going to build a world-class platform. You're going to be a badass operator. It's these moments that honestly, like I feel grateful for to have started a business and within a couple of years go through kind of a period where things aren't as beautiful and awesome and everything's just pointing in the upward direction. I'm grateful that it's happening now because it's going to really battle test our business a little bit so that when we do really, really start to meaningfully scale, we've built it on a solid foundation that's gone through those punches.
I heard this once and I love it. It's not that the problems go away. It's that our capacity to take them on grows. And when they look at it, they're like, well, it's easy for you to say because you're at this point. And I'm like, my problems, first of all, are way bigger than anything when I started out. Like, it's not even close, right? It's not. The amount of people I deal with, the bad things that happen within my business are multiplied by 100 and they're all coming out and going on, right? I have to build infrastructure to take care of them because there will never not be problems. This is life. So every asset, you're going to have something break. You're going to have an employee quit. You're going to have somebody fighting. Somebody's going to sue you. So you take that on one location, magnify it across states, across people, across businesses, right? And two, when you look at it, the time then it gets hard. So if you go through a downturn, you go through a slowdown. A perfect example is last year. Some of our markets got hit hard. Like we're talking like 60% rate drop. Well, I got investors in those properties. And I told the investors on our property, I'm like, hey, we're pausing distributions. We're not going to hold distributions because we don't know what's going to happen in the market, right? And we don't want to ever put anyone in a bad spot or risk. We got to get things turned around and everything. So you all of a sudden then have to make decisions for people, and decisions that they might not like, even though it's the right decisions to make. And two, you have to do with what you've got. If the market turns, it turns. You have to deal with that. And it's about how you deal with the problems that is actually important. Like I told somebody, I was like, you don't pay me actually to go through a market when times are good. If that was true, then you would just do it yourself. Because why? Why give your money to me? My value comes in when it goes wrong. That's why I'm valuable. It is. Like if we just knew markets were going to go up, there'd be no reason to go buy something, go in with friends, buy something, get a third-party management come in, you're going to make tons of money, right? Because it'll never end. My value comes in that I'm doing things right, I'm structuring things right, and when things go wrong, I can take it and I can make the decisions that need to be made and ride through and then actually succeed on the other end. So not only do you survive, but you can actually do better because I can take advantage of it because I've been through it, right? That's why I'm here. That's why people invest with me. And that's how you got to think about yourself. It's like, that's what your job is, right? People don't give you money. You don't take on responsibility because of things are good, so you want to make decisions. Responsibility comes for when things are bad. Nobody needs a responsible person when everything's perfect. Nobody needs somebody to make decisions when decisions don't need to be made. And that is an everlasting truth. You are there for the punches. You're not there for the show. You're not there for the lights, the stadium, and everybody to scream. You're there to get punched. And if you can't do that, that's okay. Nobody I didn't think I could do what I do now. I was way more sensitive, I guess, on lots of different things and way more cautious and everything because I didn't have the capacity. But my capacity grew. And, you'll see that. And everybody sees that. You start out and you go, I hear people are like, I don't want to do what you do because that's too much work or that's too much this, that's too much that and everything. And I'm like, I thought the same thing when I started. And guess what? It's less than when I started. It literally is less than when I started. Now, I'm not up at night because the risks I manage now because I know what they are. So for me, I have less risk today than I did, even though I have $100 million in debt. I have 100 plus employees. I've got 10 companies, right? I have less work on aggregate to income, revenue, everything else like that. I have less risk and I can take way bigger problems and the problems of size are bigger. I could have not done any of those things when I started. It's because my capacity grew. And I love you talking about that and saying, as we get back, your capacity grew. Because like you said, surviving and doing that is that's a thing of hope, right? It's like, you can do this. You don't have to be the person at the end to start because starting is how you become the person at the end. And I love seeing you just this far in your journey already talking and understanding those things as you're growing and scaling. Because I'm sure that you're surprised 3-4 years ago where you're at today. I mean, you were working at Google, why quit or anything else? And look where you are now. I mean, that's impressive.
I appreciate it. No, I appreciate that a lot. And it's awesome that you kind of said some of the things you said that, hey, I wasn't this person when I started, right? I didn't have this capacity. Like, I feel the same way. I know a lot of folks look up to people like you and they're looking at storage and they look up to the people that are already on like step 7, step 8, step 9. They're way past step 1. And you're like, well, I'm not that type of person. I can't raise capital. I'm not like extroverted. I don't have that kind of personality. It's hard for me to go and do the cold outreach, or I can't do acquisitions. I hate cold calling, or I can't run a storage facility. I don't know how I deal with break-ins and people living in the units. I couldn't do any of that stuff when I started either. Like I was 25 years old looking to raise money. I was scared out of my mind. Like I felt like, oh my God, who's going to take this 25-year-old seriously? I remember the first storage facility we had, I was the one answering the calls. And I remember getting so shooken up sometimes, at how some of those interactions went down and the threats that I would get and all that stuff. And it's like you said, at the beginning, you don't have that capacity. So you're super sensitive to all the things that happen, right? But over time, you start to get, numb's not the right word, but you get used to it. You don't have such an emotional reaction to everything that happens. You're like, I see it, I process it for what it is, and I'm going to handle it. Or I can build the infrastructure to handle it so it's completely off my plate. And that's an awesome thing. I mean, to zoom out for a second, I think that's kind of the purpose of like life sometimes, right? Is we're meant to get in these situations and grow. And so this is a perfect vehicle and perfect medium to do exactly that. Put yourself in uncomfortable situations that increasingly grow over time, and become that kind of person that can handle those things. Yeah, you're not AJ Osborne today or, whoever, but AJ Osborne wasn't AJ Osborne 10 years ago. You know what I mean? And this is a vehicle for you to get there. And it's really important. I think it's so important that a lot of times social media is there now, right? Which is a huge gift because you get to learn about the industry and you get to learn about how can I start this kind of business. But the downside of it is you start to compare yourself to people that are at step 10 or that are at year 15 of their business. And it's important for those folks to call out sometimes like, dude, I wasn't this guy 15 years ago. Like wherever you're at now, take that limiting belief off. This is how you get there.
I love it. And it's, I think, the reasons everybody too, we're talking about this, we're passionate about it is because we went through it. Like the limiting beliefs that we had, and I think everybody has it. There's no different. I think a lot of people listening to it is like, well, you were just confident and because you're confident now and everything. My confidence comes from my experience and my knowledge comes from doing. So like that, what you're seeing, right, is a result of that, not the other way around. That is probably the most important thing anybody starting out or investor, anybody else can learn. When you're reading the books, when you're doing everything else, we're trying to express that to you, share that knowledge, because frankly, it's surprising to us, honestly. It's like, wow. I mean, look at it, man. And that, I think, I can hear the passion in your voice. Like, I think people can hear it in mine. That is like a message I want to share. Like, dude, I'm an idiot. If I can do it, right? Like, they're like, this is awesome. And what you said before, it's just, you got to last. You got to take the hits, and how inspirational that is, where it's like, all you got to do is just keep going and not give up. It gets rid of this idea that I have to be a certain person or a certain way. And, I one of the best experiences I ever had was working in group medical insurance as I worked with companies. And I got to see owners over hundreds of companies of all sorts of different sizes. Some had 5 employees, others had 50,000. And they were billion-dollar companies, Fortune 500 companies. And I got to see the owners of these from 100 employees to companies that were $3 million to 30 million to 300 million, right? And the thing that I was always shocked was he's just a normal dude. He's not even that smart. And then it starts to go, all these companies, and I'm going, what is the difference? What is the difference between these guys? It's not what I thought it was. And guess what the difference was? They did it. That's it. They just did it. They just did the thing. And that simple, fundamental, simple lesson really struck home with me. And it was that they too didn't try to be, they knew what they didn't know and they were fine with it. And they weren't superhuman. They weren't smart or anything. They just did the thing. That's it. And they just kept doing the thing.
Yeah. What's really interesting about that point, we talk about mom and pop owners in storage a lot, right? And we talk about our business plan is we're going to buy from the mom and pops because we're going to make it more profitable to them. And we make it sound like the mom and pop owner, they're screwing up or something and we're coming over to fix the issue. Well, on the other side of the closing table, when we buy those properties, who's the one making millions of dollars? Is it us or is it the mom and pop, right? And so
yours is theoretical. Theirs is in the bank.
Exactly. You can come here and say, I'm so smart. I have this technology, all that. And these people, they don't know what they're doing. They're leaving money on the table. Who's the one making $1 million at the closing table? Is it you or is it them? And that just goes to show it's not about who's the smartest. It's not about who's the most skilled, who has the best platform, or who did all these little things. It's who just went and did it. Point blank, period. And, like that, the mom and pop example in storage is like the best one I can think of. Like that's the bar. You can do that and go make millions and millions and millions of dollars. So don't worry about the other stuff. It's details and all of that stuff. If they can do it, any person can do it. You know what I mean?
That's the point is that you realize really quickly, you're not supposed to know everything. That's why we have attorneys, everything else like that. You just go find the people that do to do the thing. So you don't know how to do something, that's fine. Get somebody that does and keep moving. I love it. Well, hey man, we've already been going for an hour here now. I love this conversation. I love seeing you kill it. I'm excited to see what you do in the future and your growth. Where can people go to learn more from you, find out about you, or connect with you?
Absolutely. I'm most active on LinkedIn, Faraz Hemani. You can look me up there. Our website, pebbleridgecap.com. I've got a link on there. You can reach out to me, set up time with me. I love to talk shop about all things real estate, so please don't hesitate to reach out.
Thanks, man. This was awesome. An absolute pleasure, and we'll talk to you soon.